Welcome back, everyone. Today we're talking about compounding, discounting, and required rate of return. And what is the difference? I have a lot of students that when they're first learning time value of money, they get these three terms thrown at them very quickly. And a lot of times they're like, I don't really understand, the difference and how to use it, or there's a little bit of confusion, right? So let's get into this. I think part of the confusion is the fact that on the financial calculator, we're using compounding, discounting, and required rate of return under the same key, which is the IY, the interest per year key. I think that's what kind of leads to some of the confusion. Now, I'm going to talk about each of these specifically. Some of it, the concept is different, and some of it, it's a matter of context, okay? So my goal in this video is to help clarify, what each of them is and how or when you need to use, right, compounding, discounting, or required rate of return. So let's jump into this. Let's start with compounding because it's the easiest one out of the three. I think that most people have an intuitive sense of what compounding is, just by, let's say, having a savings account or money in the bank. And when they tell you, hey, open up a CD today at this percentage, you can have this much in a year. So what is compounding? So compounding is how money grows over time. It's as simple as that, right? Your money makes money, and then that money makes more money. So back to our example. Let's say you go to the bank, you have $100. This could be $100. This could be $1,000. Let's make it interesting, and let's make it $1,000, right? In this example. So the bank says, hey, we have a savings account for 1 year. It'll pay, I know no bank, this is an example, it'll pay 5%. So you should expect that at the end of the year, you will have $1,050. And then you can keep growing that money, right? Year after year. That's compounding. It's growth. So I think most people get that. Most people understand that compounding is growth over time. So I'm not going to spend a lot of time on this, right? Nonetheless, you're still using the IY key, right, when you're looking at it in your financial calculator. Okay, so if you do have questions about compounding, please leave them down in the comment section. So let's give you guys a real world example here. So LeBron's $1 million stake in Blaze Pizza chain is now worth $35 million in just 8 years, right? This is the beauty of compounding. Your money grows over time. So let's grab our financial calculator and let's do that math. So let's clear time value of money. So for N, or the time, we have 8 years. The discount rate, right? Or sorry, the compounding rate. See, even I get them. I got to get them right. Compounding rate is what we're looking for. The present value is, he invested $1 million. It's negative because it's an investment. He made no payments. And 8 years later, it's worth $35 million. He doesn't have it. It's worth $35 million. So let's compute the compounding rate. So compute IY. So his money compounded at 95.96% on average year over year, right? Let's see here. Right? His money grew at this rate, at this compounding rate. Really incredible, beyond, let's say, an index fund or something like that. Of course, it's a new business, so it's high risk. He could have totally lost his $1 million if the business didn't do well. But in this case, the business did exceptionally well. So he's going to get a chance to reap the rewards of that. So this, again, is compounding, right? The growth of money. Okay, so here we come into a little bit more of a complicated concept, which is discounting, which is really the reverse of compounding, okay? So let's go here. Discounting is the process of figuring out, right? We're figuring out how much a future amount of money is worth today, okay? So simply, what is a future dollar worth right now? So if somebody promises you, like in this example here, if somebody promises you $105 1 year from now, what is that worth in hand to you today, right? So if we're discounting at 5%, that means that $105 a year from now is actually worth $100 to you today. Now, let's say somebody promises you $148 8 years from now, discounted at the same 5%. Well, guess what? That still gets us back to $100, right? Because it's much further out. We have a lot more years to discount back that money. So $148 8 years from now is only worth $100 today on hand. I know this is a very tricky concept. So there's two things that I'm offering you. Right now, I have a video which explains the math and how to compute the actual discounting value, right? The present value. I'm also going to make a video specifically on the concept of discounting. I really worked hard to make sure that I could, really get to the essence of what discounting is so that you guys can understand it in simple terms. I'll be posting that video very soon. Okay, so I do have an example on discounting. Look at this. Ohtani's $700 million contract with the Dodgers. Certainly an eye-popping number, right? $700 million. You say, wow, it's just incredible. But after you watch this lecture, you're going to ask yourself, okay, but when is he receiving? That's key here. When is he receiving those $700 million? Because if he's receiving those $700 million today, cash in hand, okay, wow, that's incredible. But as we'll see here, look at this payout. Look at Ohtani's $700 million contract. This is the payout schedule. I'm going to make it easy for you guys to read this. Look, for the first 10 years of the contract, he's only getting paid $2 million a year. So look at this. That's only $20 million for the first year. Now, the back half of the 10 years, because it's a 20-year contract, he's getting paid $680 million. Okay, so he's actually waiting a really long time to receive that money. There's a couple things going on here that obviously need to be considered. Up front, maybe actually getting paid by the Dodgers. Ohtani's not really super concerned about that because right now, at the height of his career, he's making a lot of money by sponsorship deals or through a lot of other venues, right? Just given his fame, maybe merchandise percentages, maybe in partnership with Nike. I'm not 100% sure, but he can make a lot of money through other venues right now while guaranteeing that he's going to get paid out by the Dodgers later on, okay? Another thing for him to consider is he has to be really confident that the Dodgers are going to be able to pay him long term. Of course, if the Dodgers continue to win, they become a dynasty, the value of that brand grows, making it easy for them to pay him later on down the line. All right, let's grab our financial calculator and figure out what the value of Ohtani's contract spread over the 20 years is actually worth in today's dollars. So we're going to go to our cash flow key. We're going to skip this CF0 because there's no initial investment. The first cash flow is 2 million. We're going to keep this in millions. So we're just going to put 2. And then the frequency, as you can see here, he gets 10 payments of 2 million. So we're going to put 10 for frequency. Go to the next set of cash flows, which is 68 million a year. Again, for 10 million. Okay, now we're going to go to net present value. Let's say the discount rate is 6.5%. All of these cash flows are getting discounted at 6.5%. 6.5% discount rate. Okay, so what we're going to do now is go to our net present value key, and we're going to put 6.5, enter. Now we're going to go down and we're going to compute the net present value. Compute. you can see that the Dodgers would need to come up with, in hand today, $275 million. So this is what they would need to pay him, $275 million. That's the equivalent of this 20-year payout, right? So this is discounting. Again, why is this important? Well, it's important to know, look at this. We're going from $700 million, right, to it actually being worth $275 million today, given the fact that we're discounting it at 6.5%, right? Now, just to make this example really sink in, what do you think this $68 million all the way out here, 20 years from now, is actually worth today, right? So let's put that in our financial calculator really quick. We're going to use our time value of money keys. So we're going to get 68 million, right, in the future. We're going to discount that at 6.5, 20 years. We're going to wait for that money and we're going to compute the present value. So look at that. That's $68 million. This one specifically, this one specific payment, right, 20 years from now is only worth $19.3 million today, cash in hand. Okay. Now, again, I have a video that specifically explains why there's such a big gap, right? It's a bit much to get into in this video, but this is discounting. All right, let's keep going. All right. So here we have, I know there's a lot to read. I've kind of highlighted the key important parts here. A lottery payout. Oh, this one apparently is out of Minneapolis. So the Mega Millions jackpot, right, has grown to $1.22 billion. This is very common in lottery. Okay. So if you were to take the winnings as a lump sum, you would actually only get about 549 million. I don't know why it says 539 here. Maybe there's some difference. But then you're still paying 131 million in tax. You're only taking home $417 million, right? So you go from 1.22 to actually 4.17. That's like a third. That's only a third cash in hand today, right? So, however, if you wait for the 30-year annuity stream, you will actually get to the $1.22 billion. Right? Now, I haven't gone through the math of figuring out what the discount rate to get us here is. If you want to figure that out, leave it in the comment section and I'll do the math later and I'll tell you if we're wrong or right. So lastly, the Mega Millions lottery has 549 million in hand right now, right? Which you can take as a lump sum or allow them to invest over time while getting a yearly payout for the next 30 years. This one is key. That one's interesting. Look at this. Allow them to invest over time so that they can pay you over the next 30 years, right? That's part of the reason that you're getting less, because actually they're calculating, it's a big number, but they're only calculating what it's worth today or giving you the equivalent of that 30 years divided over 30 years. Okay? All right, let's keep going. Required rate of return. So there are a key things to remember here. So the required rate of return is the minimum return. This is key. An investor or company expects based on the level of risk of an investment. It's the minimum return, right? That you're willing to put your money at risk, your hard-earned dollars, or a company is willing to invest in a product, but it knows it has shareholders that demand a certain required rate of return. So let's get into this. We're going to do this quickly. I don't want this video to be too long. So down here, we have risk and return from the lowest risk to the highest risk. In this example, you're an investor. The lowest possible risk, the near risklessness, right, is U.S. Treasuries. So you can invest in a 1 year, 3 year, 5 year, 10-year U.S. Treasury. It's not going to pay a whole lot, but you're guaranteed to get your principal plus your investment. Let's say here you can get 3.5% return. Okay. Now, the next investment is an electric company that has a monopoly over a growing city, right? So, you know, it's electricity, people need it, it's monopoly, right? It's a little bit more risky, right? Because the business could be mismanaged. But let's say that you're willing to take this on for 6.5%. Okay. Now, let's say you want to put your money in the S&P 500, right? The top 500 publicly traded companies in the US. Now, we know that typically pays between 8.5 and 10.5% returns on average year over year. So that's what we would expect your required rate of return as an investor to be. Now, that doesn't mean that some years it won't be 10, 20, 25 returns, and some years it might be negative 10, negative 20 returns, right? On average, this is what you should expect. And the highest risk, let's say you're looking at a new biotechnology company that's IPOing today, right? Well, it's a very risky industry. The probability of success is low. So you might actually want anywhere between 18, 22 or higher, you know, because it's really risky. There could be a lot of risk associated with this, okay? So as an investor, this is where required rate of return sort of falls. Now, real estate, again, we're using required rate of return. Let's say this is you, right? And you go to the bank, and the bank says, yeah, we will lend you money at 6% for 30 years. You say, great. All right. So you go out, you look at a rental property. The first one you look at, you know, you look at the price, you look at what the rent's going to generate. This generates, let's say, 5.5% per year. Well, if the bank's loaning you money at 6 and this rental property only generates 5.5%, you're really losing money there, right? You're really losing money there. So let's go to the next one. Let's say you find another rental property, and here you find a house for $400,000. Okay, and this investment generates a 6% return, which means that rent is $2,000 a month or $24,000 a year. Well, this generates exactly the amount that pays you the bank, but it doesn't leave you anything, right? It doesn't leave you anything, any place to make money. So it's certainly not worth it. Okay. Now let's get a little bit more interesting. You're looking at a fourplex or an apartment complex. Let's keep it as a fourplex. So now it's a little bit more expensive, right? $750,000. But this actually generates a return of 7.5%, right? Let's put that into our calculator. 700,000. So a year that generates 52,500. The bank's still loaning you that money at 6%. You get to keep that difference. So the 750, right? You're actually making, you're gonna have to take my word for it here, otherwise this video will be. This is what you're making at 7.5%. So you need to decide, is that 1.5%, is it worth my trouble, right? You know, how much risk am I taking on? How guaranteed are the rents? Now, let's say you look at this very similar, right? $750,000. You're looking at this Airbnb property, right? And this is actually going to generate 8.25%. So now the gap is getting bigger between this 8.25 and the 6%. Now it's getting more interesting. So that means that the rent is going to generate you $61,875. And that the gap between that 6% and the 8.25, that's a 2.25% gap, right? So 750 times 0.0225. What you end up with is at the end of the year, 16,875, right? Now, there are different levels of risk, right? And more work associated with an Airbnb. So you need to figure out what is worth it for for you. That's how required rate of return comes into play when we're talking about real estate. Okay, I hope that example was, I hope they were good examples. Now, let's say that you and your partners, which I have here, right, decide to form a new business, or you're part of a company that's going to take on a new project. Well, the required rate of return is the minimum you're willing to accept to take on a project for a specific level of risk. Okay. Now, the way that we actually look at required rate of returns in this scenario is we look at the money we invest up front, and then we calculate the money that we're receiving over the course of the life of the company or the project. And the required rate of return is what we use. Required rate of return is the percentage we use to actually discount back these cash flows. This is called net present value. You may or may not be there in your time value of money journey, but that's how we use required rate of return when it comes to investments, when it comes to corporate investments or taking on a project or something like this, right? This is our initial investment. These are our cash flows from the project or the business that we took off. And then the required rate of return is the rate we use to discount to find the net present value. If the net present value is positive, it's a good project, we should consider taking it on. If it's negative, that means these cash flows are not big enough to offset our initial investment. Okay, we're almost done here. Now, lastly, there are some advanced topics, but I didn't feel like this was the right place. We have weighted average cost of capital, hurdle rate, and risk-adjusted cost of capital. But it's really important that you become comfortable with compounding, discounting, and required rate of return, so that then when you move on to these more advanced topics, you're really able to understand them fully, understand what's being asked of you, and how to compute, right? Either the net present value or the correct, that sort of thing. All right. I hope this video was useful. I'm going to build on this. If you have any questions, I welcome them. And I'll see you guys in the next video.